Hi everyone, I'm pleased to present the last presentation of the day with Solitron and Tim Erickson. Tim Erickson is also the investment manager of Cedar Creek Partners, as you can see. So it's an interesting combination of investor, activist, and operator all in one presentation, which I'm excited to hear about. Cedar Creek Partners specializes in overlooked and illiquid microcaps, often even more overlooked and illiquid than we're used to today, like in this room, talking about, OTC, pink sheet stocks, expert market stocks the fund has allocations to. And this has been very successful. The fund started in 2006 and has achieved a 14.4% CAGR since then to present, which is above all of the comparable market benchmarks. In 2016, as part of the fund's activities, Tim was part of an activist campaign and eventually took over as CEO of Solitron Devices, SODI, and participated in the turnaround of that company to date. Solitron Devices is a semiconductor parts manufacturer to primarily the aerospace and defense markets. So like Raytheon is the largest customer, a lot of exposure to those end markets. And this is an industry that he'll talk about, but it's characterized by a large focus on quality and reliability rather than pure price competition, and Solitron has a multi-decade track record of high quality supplying this market. That investment and Tim as CEO has been very successful to date. He took over Solitron when it was $3.50 a share in 2016, and today it's trading at $18 a share, with potentially more opportunity to run in the future. And yeah, with that, I'll stop talking about all of these successes and let you talk about it a little bit as well.
You were doing great. You were covering most of what I thought I was going to have to say, so it's great. Yeah, they asked me to talk about both my fund and the company, so I'm trying to squeeze both things in there. And so really with the fund, it's not like I'm trying to market the fund to anybody. It's more of really the philosophy, and I'm going to be preaching to the choir because this is a microcap group. So I'm not really trying to sell you on microcap investing, but hopefully you can gain some nuggets of really what I'm presenting in terms of just application to your own investing approach. So there'll be some good reminders, I hope, and things like that. So disclaimers, whatever. And Michael already kind of covered most of this, so of background and really why I started my firm and really focusing on the microcaps and the Solitron experience. I'm also chairman of the board of PharmChem, just finished being on the board of TSR. We sold that company at the end of June. Then educational background there and along with work experience prior to working at my fund. I worked for Walker's Manual, which was really helpful for me to focus on microcaps and community banks, especially I think the bank focus just really helped me to look at businesses, to look at, I think of banks as having a fairly sticky customer, and then being able to just kind of see, plowing the earnings right back into the business and seeing the value of compounding earnings and stuff that happens with community banks. And also looking for inflection points as banks kind of grow in size. They have some unique quirks as they're reserving when they make loans. Their earnings are masked for a few quarters when they hit that inflection point, because you make a loan and you have a spread. So just say you had a 4% spread, you make a loan. If you do a typical 1% loan loss reserve, that quarter is going to show no gain on that loan and may even show a loss if you made the loan near the end of the quarter. So banks are just sort of interesting animals, really I think a good educational experience for me. And if you haven't spent time with banks, I would encourage you to do it, whether you really have thought about it or not. So yeah, that's the fund's average annual returns versus the other indices. We've done well. I think a good reminder here is where we're at like 14.4, and you can see the 11.7 for NASDAQ and 10.2 for the S&P. When you see that over time, it makes a big dollar difference. And in my case, because I've been doing this fund for 18 years, that 14.4 versus the 11.7, 2.7 percentage points, but it's a 50% difference in the valuation after 18 years of 1.2 million versus under 800 grand. And if I compare it to the S&P, it's almost a 2x valuation of 14.4 versus 10.7. So those incremental returns really do matter over time. So that's why we spend the time, hunting in these fishing grounds, is trying to get those returns that beat the S&P or beat the NASDAQ, which has gotten really hard the last few years to beat the NASDAQ. So philosophy, I'm a very much a bottom-up, typical value investor, looking for, things that are neglected, looking at things that are trading below my estimate of intrinsic value. I'm very focused on free cash flow, so I'm not in these turnarounds or before something's earning money. I don't like things that are losing money. I think the easiest way to lose money is to buy something that's losing money. Ideal company is growing its intrinsic value, has this good pricing power, has good sales growth opportunities, good management in place, but finding the perfect company that's in a microcap is nearly impossible. And if you do find it, it's trading at 30 times earnings. So, you have to hunt a lot, and you're going to give up a little in different areas, right, to find an attractive investment. We do like to find things that have catalysts because we're not looking to have this value trap that sits around forever, not earning money and not growing. And then an important part of that component is just really avoiding excessive diversification. I'm not wanting to own 101% positions or 52% positions. I'm looking to concentrate in my best ideas, and you've got to really then dig deep of what is better and to rank them. Even the 10 at 10% or the 20 at 5% is not my approach. If I can't figure out which one's better, then I got to ask why I'm doing this. Big lesson of the last decade, really decade and a half since post-2008, the great financial crisis is really, I think a lot of people learned the wrong lesson. Everybody went down 30% and we're like, oh my gosh, I need to factor in the macro. I really got to look at that. And I think that was the wrong lesson. It's like, look, everybody took the hit, take it. Stick with just looking at the businesses. You're not going to be able to predict the macro environment, and most all those investors have underperformed the last decade and a half because now I don't know about the economy and and it's like it's not how you make money, really. At least that's not what Templeton or Buffett would say, and I'll go with them every day. Obviously, we all take advantage of being smaller. There's some quotes there from three great books there from The Outsiders, Joel Greenblatt's You Can Be a Stock Market Genius, or Seth Klarman's Margin of Safety. But yeah, you got to do something different. You got to be on the small end. You got to do something that Vanguard's not doing in their little index portfolio. And I think we all understand, these smaller companies, the businesses are simpler. If you've ever thinking of a bank, if you ever pull out Wells Fargo's 10K or Bank of America, you're just going to be going, what in the world am I looking at? Because there's just so many moving parts. You're just like, I think it would take 5 analysts to just cover some of those major banks. But you can look at a community bank and read it through pretty quickly. And that's true in everybody who's presented here. You can go through their 10Ks or 10Qs in so much a shorter time, and I think understand the business. You can talk to the CEO. You got so many things that you can do. It's ignored by the large institutions, which I would say the smartest people in the room are ignoring it. And I like to be the only guy in the room. That's the best way to guarantee I'm the smartest guy in the room. So. And they're likely to be mispriced. Information is just not acted on sooner. Microsoft does an announcement that's going to be reflected in seconds, it seems like, in the pricing of things. We've seen microcaps that make an announcement, and it takes not just hours, it can take days, weeks, or months, before the information really begins to get incorporated in the stock price. Sometimes it takes a couple quarters and you still have these opportunities. It's amazing. And it helps you outperform. So this is a stale statistic because I haven't, Heartland Advisors put this out and then they kind of quit doing it. And I'm sure it's narrowed in the last few years and maybe large caps caught up. Historically, microcap, it was the best performing area over small or mid or large. Like I said, I'm sure large is caught up, but pretty close. But I'll stick with the microcap every day with the lower valuations than trying to buy the large cap at 30 times earnings. This was an interesting stat that I came across, and I did a horrible job of presenting this, so I just apologize. This is just horrible. So look at the bold font at the bottom, but this is like overall market return of 10% over this time period going back, this is going back to the 60s. But those that increased their share count over that time, their average annual return was 3.8%. Those that kept their share count steady, 17.4%, and those that reduced the share count, which I thought would have been much better, was 18%. But I mean, that tells you, and the only way that happens is if you're profitable, because if you're losing money, you're going to have to dilute. So to me, it's like, it was just a reminder, focus on profitable companies and focus on companies that can at least maintain their share count or that aren't diluting you, or if there is any stock issuance, are able to offset that. Just massive difference in returns. And obviously, if somebody's profitable, they're not going bankrupt. I mean, it's really hard unless you got accounting shenanigans, and then they weren't really profitable. So, for me, I look at this as the value investing spectrum, and the green arrow is kind of where I'm at and how I approach things, kind of a low price to earnings power value, if you follow Bruce Greenwald at Columbia. I'm looking to buy things under 10 times earnings. If I can get it at 6 or 8 is even better. I'm not saying I want zero growth. I don't want declining. I love to pay a low PE and have high growth. But I can go anywhere on this spectrum, especially to the left. I have no problem going down to the nets that's like, oh, this is trading way below its liquidation value or way below its cash, or at a real discount to price to book. I'm comfortable going there. I have a hard time going to the right, and I think almost all of us do. And I think one of the things is for me is learning how to expand that way without making mistakes. Learning how to, when it's right to pay 20, 25 times earnings, and what is the growth rate necessary to do that, and how do I trust that growth rate's going to be realized. Being willing, I guess I would say growth. It can still be value investing. All investing, if you're buying below your estimate of intrinsic value, is value investing. It doesn't mean they have current cash flow, right? It's discounted cash flow is brought back to the present. So you could be at 0 right now in the current year, but future years be high enough, to justify a stock price or a high stock price. I still haven't mastered it, and I'm not saying I'm suddenly moving a bunch of my portfolio trying to figure it out, but I think we always should be learning, and trying to figure that out and recognize, especially when you meet people that can do it, get to know them, that are especially anywhere different in the category. I think it always helps. Michael didn't talk about it other than, Solitron, I did Activism. Didn't ever intend to do Activism when I started out managing money. But Solitron, it just came along, so I learned how to do Activism on my own, kind of, in 2015 for that annual meeting, and then 2016 we had the CEO change. And that's the average annual return of Solitron since I took over as CEO, which is a title, CEO and CFO. CFO, I do actual work of that. CEO, we have a COO, so we have someone running the business. I don't know why I have the CEO title. He didn't care, but I do. So I handle, shareholder relations. I am CFO, so I handle, financial filings. I guess I'm the IR team. If somebody asks a question, I'm the one that's going to talk to them. Those few shareholders out there that give me 2 or 3 hour calls every quarter, I'm the one that gets to talk to them and do that. Done other activism, TSR, as well in 2019 as a nominee for Zeph Capital. And like I said, we just sold that, and that was a great return for shareholders. And one of the craziest board fights ever, because he had a deal that said, hey, buy me out, and my 2 guys will resign. Don't buy me out, the rest of the board has to resign. And they didn't do the buyout, so December 31st of 2019, there was seven board members. 5 of them had to resign, which left Brad Turpak and myself as the board members. Zeph suddenly had control. We did a CEO change, and then worked on building the business, and sold it successfully. So it was a lot of fun, a lot of work, but really good experience. I'm also chairman of the board of PharmChem. My fund owns like a third of that. And then I'm doing some activism with Pacific Coast Oil Trust, which is in the expert market. Just a mess of a thing, but I still think it's trading at a discount to what unit investors will eventually get. So I'm looking forward to some resolution one of these years there. I also spend a lot of time with expert market. And if you're an individual investor, you're like, yeah, well, I can't do that. Well, you can, but you can't do it through Interactive Brokers or Schwab or TD or whatever. There are specialty brokers out there. Yes, you probably are going to have to put in a 100 or a 200 grand account, so it's not easy to get in there, but there are individuals that are working their way in there with brokerage firms willing to pay. You're not getting 0 commissions or $6.95. You may pay $50 or more, but you can buy a whole host of companies at some incredible valuations or deep discounts to book. There's a list of some of the stuff in there. I wrote about First IC in my last investor letter that, I was probably paying 2 times earnings for a bank outside of Atlanta. That was with a dividend yield of mid-teens. So, I was happy to buy that bank. Dyna Group trades below cash. It's like a 60-cent stock with 13 cents of earnings annually and has more than that of cash. There's just Evercell's liquidating, but all kinds of stuff in there. Just a fun area to fish because there's not too many people there. So that's kind of the gist of the fun part, but I know I went through it quickly, but As Michael said, it took over Solitron in 2016. I'm the CEO, CFO. There's 2.08 million shares outstanding now. I think that's down from about, fully diluted, we were about 2.5. We bought back the former CEO's shares and his stock options. Share price 18, so you're about a 37 million market cap. We're doing, what's our run rate? Probably 14, 15 million of sales. So we have a decently high price to sales there. And the industry, as you know, is manufacturing, assembling electronic components for defense. We did an acquisition that's talked about at the bottom of the screen that does medical industry. So now it's defense and medical, where they make, it's really a power device inside of a surgical handsaw. So it's still an electronic component. It's just what is the end product there of it being used for. Be happy to answer any questions about Activism. It's a challenging thing. It's an expensive thing to do, especially when you have staggered boards, which Solitron had, which means you have to do it more than once. We righted the ship. We went through, if you knew the history, we went through, I call it audit hell in 2017 to 2019. We just had an auditor that, I don't know, I don't think they understood accounting. They said things that were blatantly incorrect, and then they just, we're almost done, and then they weren't done. But then they got to where they were billing us time, and they just kept they billed us 7 figures before we fired them. It was just terrible. But it nearly destroyed the company. But at that bottom, it drove the stock price, probably cut it in half. We were probably in the high dollar range. But we communicated to shareholders, and I think it's really important that CEOs do this, and I try to do it, is give the details, of what are the one-time costs so you can see what is the real profitability here. You're not trying to hype something, you're just trying to give the realistic picture. So it's like, look, if this was my one-time cost, then it is. Don't add anything. You don't have to have tons of adjustments, to me, but it's just, in that case, it's like, look, we're not going to keep spending that kind of money on the audit, or we had inventory write-downs. It's like, well, those were non-cash, So understanding what things were going to continue and what things weren't. And a lot of investors, came in at that time and were able to just buy the stock at a bargain. When I couldn't because we weren't current in our filings, and it was a little painful. But anyways, we righted the ship, started, really cranking out orders in 2022. And I wish I had pictures of this, and I should. I know next time if I ever do this, of the old building and the new building. The old building was 50,000 square feet, and we needed that for the cockroaches and all the leaks in the roof. So we cut it down to like 25,000 square feet now. I'm serious. We used to have you just see them usually dead, but quite often alive too. But anyways, we moved to a different part of town just to, really change the part of changing the culture and the image of the company, making people go, yeah, I work there, not, we're not driving by where I work at all. In fact, we're not even, you didn't want to drive by there. Certainly at night, you didn't want to go by there. But so we relocated. It cost us, I don't know what we paid, $4 million for the building, and we had a couple million of build-out costs. Then building cash back up, and then last year we did an acquisition, which was just dropped into our lap from one of the directors that brought it along, and it was just an incredible deal. We paid $3 million plus an earnout, which could earn them out, I think it's 6% of revenue or something, maybe about $500,000 a year for the next 3 years. So the max payout was probably going to be about $4.5 million. Company is doing $6 million as it says, and 1.2 to 1.4 pre-tax. So on a $4 million, you're like, oh, well, that's under 4 times earnings, closer to 3. But then when you go back and you're like, wow, no debt. No, look at that, $500,000 in cash. So my net purchase price goes down $500,000. You got $775,000 of receivables, and our payables were probably a couple $100,000. So that's really money that was going to come in. So additional cash that was going to come in over the next few months. Inventory was a couple million, and we had to write that up due to the acquisition, moving it to fair value by I think $700,000. So our risk of loss on the deal was just incredible, because we're like, if that biggest customer we had one customer, 95%, but if that customer quit in 6 months or a year, we could collect our cash, collect our receivables, our finished goods were there, sell them the finished goods, complete things, and we were still going to come out ahead of what we laid out in initial cash, because we wouldn't have had to pay the earnout for the next couple years. So it was just a really good deal. Solitron would love to do additional acquisitions. We do not ever expect to be able to get that price range, but we do think we can find things in the mid-single digit range that are in related, or in that industry, at least the defense industry. They don't have to be electronics components, but we do want it to really be in the defense industry. We're not trying to build a little mini Berkshire or do things with, some kind of a little conglomerate all over the place. So we don't think that would help our valuation to have, really different businesses under one roof. This was one of the things I did when I first started, when I first took over as CEO. I was like, I got to do this. I got to sit down and really think, how our earnings results really seem to bounce when our revenue changes. So I plotted it, and you can see the upward slope, and it's with the scale, everything is kind of every 500 grand, but you really could see that our upward incremental margins were about 50%. It's just incredible. And this is updated to 2023, but it looked the same when I did this, 6-7 years ago. It was a tighter bunch. We didn't have a couple of the outliers there, but it was like, okay, this is great. We know this, and I knew it intuitively based on looking at the financials. What was our fixed cost, of rent and our utilities, and it's like, so when we make something additional, we have the labor and the materials, but we don't have additional rent, we don't have additional utilities, we don't have additional supervision, we don't have additional SG&A, which isn't in this gross profit, but in our net profit. So it's like, this should all drop almost to the bottom line, and we didn't pay taxes. The previous company had NOLs, we didn't pay taxes. So it's like, we just got to figure out how to do this. But that was the hard part. It isn't like, so many businesses, it's like, well, we advertise and we can get more customers, or we change our pricing and we can get more customers, and figure out our optimal margin based on, what volume would be at certain pricing. We don't have that in the defense industry, because instead of this price taker, price setter, I guess I would use the analogy, maybe we were a volume taker. Raytheon's going to say, we need 500 or 1,000 of these, and that's it. It didn't. There's a formula for setting the price because it was a large federal contract. But, we were the volume taker. So we couldn't do anything about that in that. We couldn't get back into old programs either, because they already have engineered it. They've already tested everything with those other companies as suppliers. So unless somebody screws up, you're not getting back into those older programs. So you got to wait till the new ones come, or you got to go and just drum up business on either one-off orders or new ideas or space launches with other companies. So, organic growth has been challenging. We've worked hard to do it. We have some things coming up that we'll talk about as well. I can talk about it now, I guess. In terms of that organic growth, we've tried for the singles and the home runs. I think there's a balance there for us. Every company's different. We are in one of the next programs of hypersonic missile, but it's still in testing phase, so we don't know when that kicks in, to what level it kicks in, because it's a ridiculously expensive missile. But we have components in there. We were close to a deal with Ferrari for the electric vehicles, and it would have been awesome to be able to stand up here and show Ferrari as a top 10 customer, and it was like one of the highlights of my career. I get this email, CEO of Ferrari wants to talk to you, and I'm like, yeah, ha, 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 it's like, you're full of it. So I told our sales guy, and he was like, no, I'm serious. The CEO of Ferrari wants to have a conference call, and I'm like, okay, but you better have everybody else on it, because I don't know the products that well. I'm the CFO guy, not the COO guy. But we did. We had a call, and it turned out they figured out another way to solve it versus what we did. But it would have been great to be in their EVs, but we're going to keep working on those type of things, whatever it is, of EV stations to all kinds of things, and we interact with a lot of companies on those things. And we have new opportunities with the acquisition we did with microengineering. As much as they had a 95% customer, they also had some defense industries, and they've had historical things they used to do that we're trying to resurrect. So there are organic program opportunities, and then under increased domestic demand down here is in 2022 was the signing of the bill for the stockpile program, which included about, I think, like 15 major programs that the U.S. Defense Department does. And they said, look, we realize our stockpiles are low because of what's going on in Ukraine and what potentially could go on in Taiwan. We're sending all these things over there. We need to replenish our stockpiles. So they have this program and certain quantities to do that. It'll take 4 or 5 years at least, because these programs, some of them are already running at capacity and they're expanding capacity, but we don't really know yet how quickly that revenue will come to us. Historical Solitron was 11 million. We added 6 million with microengineering, putting us maybe on a 17 million annual run rate. That extra 4 or 5 a year would be huge, depending on when that comes in. But that's kind of part of our organic growth. Kind of mixing organic growth with some financials at the bottom of there. But inorganic, as we saw with the acquisition, we already, I don't know what we last reported for cash, because I look at a lot of companies' numbers. Maybe cash and investments. We're only 2.5 million, probably, is what we reported at February. We're going to be building that up as we're profitable. Maybe whatever. I guess I can't say that number. That's Reg FD. Anyways, we're going to be building that up. If you looked at the last 6 months right there, pro forma, which is also pretty close to cash, it was about $1.7 million over the 6 months on 8 million of revenue. So you can see we're building that up if we can maintain that. I can say that. If you ballpark that, maybe you're at a 3 to 3.5 million of annual free cash flow, or at least, of annual operating income, which is after SG&A. So we'd have a little bit of interest costs, so a little bit less, maybe 3 million, but our taxes are all non-cash. So as we build that up, we want to be able to use that to do incremental acquisitions. They may not be as good as microengineering, but if we can pay 5 times earnings, we'd be happy to do that and just, rinse and repeat, and if we used a little debt, happy to do that, It's going to be hard to price stock out of the company, but it would have to be an incredible deal, or our stock price be a little bit inflated, but we would consider that. Let's see, what I would want to say. I think one of the ways we look at things, as we looked at the margin, I don't want to get anybody to think that no matter any incremental revenue we did, we're going to always have this 50% margin, because I talk about it with the COO a lot. If we could do something at small margins, at a higher volume, that didn't take much CapEx, you don't pass on it. You don't go, well, that doesn't make 40% margin or whatever. I don't care if it's 20% margin. If it doesn't cost much CapEx, what's your risk, or inventory costs? It's like, we'll do a deal at a lower margin. The whole point is to create shareholder value. So we're not wedded to being high margin. We desire to be high margin, but we're not stuck to that. That kind of covers all I got. I had no pictures, so I didn't have anything really fun and exciting. I apologize for that, but hey, we're late in the day. You've gone through a lot of these, but I'll take any questions about Solitron, any questions about Cedar Creek, about investing, activism, whatever. You guys have an
Tim,
open
maybe
floor.
one question to start, sort of bordering all three. When you think about being an operator, I'm curious how it's influenced your investing, and specifically if there's anything that when you go into looking at a new company now that you ask management, you look into, you check some source that other people wouldn't naturally think of intuitively.
I'll acknowledge, first of all, that I'm not in the camp of, I'm always calling the company and interacting with management, because I haven't been finding that always very fruitful. But when I do, yes, I think I've learned from being on the inside of companies and seeing the detailed financials of really thinking about incremental margins a lot more and asking them questions related to that, growth opportunities, and whether that's a manufacturing firm, it could even be a bank, Same thing, you got fixed costs, you got your branches, you got different things, if the bank can get larger, you're asking of can their profit margins expand? So I really think about expansion of profit margins on the upside, and I think about it on the downside of something whose sales could decline. So I really want to find something that I can estimate their revenue pretty accurately, and that's hard. I think probably everybody in this room has probably bought something expecting revenue to go up in the quarter, and all of a sudden you're like, minus 20, and the stock goes down 30%. You're like, no! That happens. Yeah. I try to avoid owning those type of companies as much as possible. So then you're searching for data points, however you can do that. Competitors, you're trying everything you can, right, to try to figure out that you can figure out how they're doing.
Does anybody else have a question?
It's that late in the day, huh? I'll just take it that I covered everything so well.
Yeah, I guess I'm curious on the expert market component of the fund portfolio. I think you said it was 23 or 26% of the capital.
Yeah.
Do you have to? I imagine liquidity is pretty thin. Do you have to view those more like long-term hold investments that, hey, I'm probably getting in this thing until there's a buyout or until they uplist? I imagine you can't move a lot of dollars
I
in
mean,
and out.
you got to be viewing it almost like you would some over-the-counter, family-controlled something where they say, "Hey, we're not going to sell out. You know, we're trying to make this a permanent thing." So you're viewing it in the same camp. Usually, there can be one of those expert markets is like filed to become current. So it's like if they're filing their S1 and they're going to be trying to get current again, then they're going to get listed on the NASDAQ. You have a liquidity event in terms of, now you have buyers, right? And probably a more reasonable valuation. Or you hope they're going to be selling. So you're looking for clues. Are they looking to exit the position? So at least you have a catalyst and a shorter term timing. Because yes, you don't really want to go, man, I'm going to own this forever. But at the right price, you're like, okay, I'll have 2 or 3% in that. I mean, I don't make these individually 10% positions type of thing. It is different. It is different than a normal, because of liquidity in a portfolio, especially if it was private. In my own portfolio, I could handle different risk levels. But yeah, it's a good question.
And are you having to go source Thank you. Are you having to go find the holders and find blocks of shares to be able to get the volume on your own, or are the brokers you're working through able to do that?
Usually the broker's been able to do that. Like one of the largest ones that was, a year or so ago was Propel Media. The broker was able to go to the other broker listing it, and then I don't think my broker didn't talk directly to the owner, but it was able to be, open the communication channels to where, hey, we have interest in a large block. Do you have interest in selling a large block? And then paired something together where you had something that hadn't traded, and suddenly I was able to do, 3 or 4 million shares at 23 cents in like a week. And then it didn't trade again. So yes, you do need that. And then you got to be willing to pay. And then my broker made a sweet commission on that. And I was glad to pay him for it. I mean, it was really, huge. I mean, I'm not talking hundreds of dollars. I mean, you're talking a big commission, but it was well worth it because how else am I going to get it? And he talked him down from a lot in price. So he saved me money. I mean, I would have just paid the ask otherwise, and I would have lost out, or not done the deal, and I would have lost out. So it does make it hard as a retailer. Even if you find a broker, the guy that's on the low end isn't going to probably go do that. You know what I mean? If you put 200 grand in an account and you're putting a bid on something, how much is he going to source that versus a fund, that has 15, 20 million at that brokerage firm is going to do a lot more for you. I mean, that is a reality too, but, because he knows what you're going to do. So.
Okay. Thank you, Tim.
Happy to answer anything else later, except when I'm eating dinner with my wife. She won't like that. So thank you, guys.
Thank you.